Hello and welcome back to Market Shares. I'm your host, Tony Blodgett, and let's talk about what's going on in the world of mortgage and real estate. And I'm going to start off today talking about a press conference that was on April 22nd, and this was held by Bill Pulte of the FHFA and Scott Turner, the Secretary of HUD. And hey, believe it or not, all this talk that we had earlier this year, at the end of last year, about the VantageScore and the FICO 10T, well, looks like this one moved through the bureaucratic system a little quicker than expected. And they had that press conference announcing that Fannie, Freddie, and soon-to-be FHA will be accepting the new VantageScore and 10T. Now, you would like to think this brought a lot of clarity as to how that's all going to work, but let's be honest, like most things that the government rolls out, it was a great announcement. I watched the whole press conference, but it still left a lot of unanswered questions. What they referred to was a handful, like 20 to 25 lenders that were going to be giving early access. They said they've been testing this with some lenders already. I think New Res was one of them. And they said they had funded like 10 million loans. And I'm like, okay, or 10 million, dollars worth of loans. Like, this is not a lot of loans that they have done. That's actually not a big number at all if you think about the overall mortgage market. But nonetheless, they did come out and officially say they will start taking these VantageScore and 10T. And if you remember, the big advantage of the VantageScore is, well, a couple things. One, we're talking about more competition for FICO, right? A new credit scoring model. They were very clear to say that they're, because FICO has their own version of this new score. They call it the 10T. But Vantage is kind of the new player on the block, if you will. And Bill Pulte made it very clear, like, we don't have a preference on who wins out with this battle. We just want this new scoring model that is, in their opinion, a better way of evaluating a borrower's credit risk profile. Now, we've talked about this a lot in other episodes, so I'm not going to go too much into what the Vantage and 10T are, just that there's a new announcement that they will now be accepting them, and it looks like about 25 or so lenders will be given that early access. We do not have the list. They mentioned a few just off the cuff in that press conference, which was PennyMac and Rocket. I think we also know that New Res has already been working with them, delivering some loans. But look, this is going to be your largest lenders around the country that will have early access. And I think everyone is waiting for that to finalize on who that's going to be. But here's the thing that I'm a little confused on. One of the biggest proponents and value of the new scoring model is that it takes into consideration your rent. Okay. Now, look, if I've been in the mortgage business now for almost 30 years, and we all know that someone's propensity to make their rent payment is a huge contributing factor to whether or not they're going to make their mortgage payment on time. And, this is something that I learned very early on, is you could have somebody who might miss a payment on one of their credit cards here and there or whatever, but if they're making their mortgage payment on time, their rent payment on time, they're likely to make their mortgage payment on time. And the reality is people care a lot more about having a roof over their head than they might on having a late fee or even a 30-day late on their credit report if things are really tough. And so the average consumer has a propensity to pay their mortgage first and let their other bills, kind of stack up, if you will. I mean, if you only have so much money and you're going to pay something, chances are you're going to make sure you keep the house over your family's head, right? And so this is huge because a lot of people who have challenged credit reports by standard calculations probably pay their rent on time. And this might help a lot of people get into homes. But here's the thing. like how many landlords are actually reporting someone's rent to the credit bureau? Well, I'll answer it for you. It's not very many. And really, it's probably only like the larger apartment complexes that have, large management companies, et cetera, that are even reporting this information to the credit bureaus. I mean, your typical local landlord, or if you're renting a single family home from, just a landlord who owns just a handful of doors, the likelihood of them reporting this is very slim. So I'm starting to wonder, like, how much of an impact is this really going to have? And based on the research that I've done, there isn't a way for you to, for instance, upload a client's rental history and have that factored into the score. And the reason that would be important is because FHFA is going to use this scoring model in their automated underwriting system. So instead of using your traditional credit score, they'll use the VantageScore or the 10T, and they will reconfigure the AUS systems, the automated underwriting systems, DU and LP, to underwrite to these kind of new credit standards. But if rent isn't included because the landlord doesn't report it, I just don't know how much of a significant difference this is going to make for a number of people. And what we haven't seen yet is anything that's requiring landlords to report this information to the credit bureaus. So maybe that's something that, is coming in the future. I don't know. I've heard no talk about that. So it'll be interesting to see how that plays out. Now, one thing that I was thinking about is, you could... A couple things. You could counsel your first-time home buyers or your borrowers in general to ask their landlord about reporting their rent to the credit bureau. So if I'm a person who's teaching first-time home buyer classes, as an example, this is probably something I would start talking about, is to ask your landlord if that's something they do or if they would consider doing. My guess is there's also companies, I know there's companies that do like contract collection, right? So if you have a private note between you and another party, oftentimes you can use a third party to collect those payments, and those could get reported to the bureau. So maybe people start paying their rent strategically through a third party that will report this information if it ends up making that much of a significant difference in whether or not you can qualify to purchase a home. So these are kind of the questions for me that are circulating around this VantageScore. I think it's very cool that they announced this just a few months ago via Twitter, if you remember, on X. Bill Pulte messaged about it, and here we are. They're having a press conference saying we're ready to start taking these. I don't think the industry is quite ready yet, and we really don't know what the impact is. But I will tell you, the FHFA seller guide for Fannie Mae and Freddie Mac has been updated to include the Vantage and FICO 10T. FHA is still a little bit behind, but they said within the next couple of months, they should be accepting them as well. But many of your lenders, if you're a broker or even if you're a mortgage banker and your company wasn't selected, or you don't work with any companies that have been selected to deliver these, we're probably still a little ways out from seeing this become mainstream, but it's definitely progressing. And look, I think that's probably a good thing, but also a lot of questions about how this is all going to work. One other thing to note is that I think it was Bill Pulte mentioned he had just literally, at the time that he was doing this press conference on the 22nd here of April, mentioned that he was talking to the folks at FICO, and they supposedly are going to offer this new report for just this new credit score for just 99 cents. That's a pretty big savings from where it's at right now. Now, keep in mind, when you're paying for a credit report through a credit vendor, you're paying significantly more than that. But right now, we're probably thinking about $10 per bureau, and we're talking now about maybe 99 cents. So that's significant. So it might help bring down cost of credit reports. Okay, a few other things going on in the market. I was just listening to an article, a podcast this morning. Actually, I think it was a news broadcast talking about what we're seeing right now in the market is kind of a tale of two markets. And what it was referring to is that the high-end luxury market is actually still doing very well. And it was a little bit surprising to me, but when you think about the reasons why, it's because high-end borrowers aren't as impacted by the fluctuations in interest rates, right? They don't have the same affordability challenges that your first-time and move-up buyers might be dealing with. So the luxury markets in many parts of the country are doing very, very well, not really, having the issues because of the recent spike up here in interest rates again. And many of those are, primarily cash buyers, or at least a substantial amount of cash down. Now, on the other side, we do have the first-time home buyer market is struggling right now. Interest rates have popped back up. We've talked about this a lot. At the end of February, we had dipped under 6%. And then with the start of the war in Iran, we have seen interest rates spike back up into the low to mid sixes. And for some first-time home buyers, maybe with challenged credit, things of that nature, they can be even higher than that. And you put on top of that, the home prices obviously have not been significantly going down. Matter of fact, most parts of the country are still seeing very moderate appreciation. There are states that are losing some value where we have lots of inventory. But for the most part, affordability hasn't gotten much better, and rates popping back up over 6 isn't helping. So, a couple things that I think about is, one, you want to be as diverse as you can in the clients that you service, right? So if you've primarily only worked with first-time home buyers, and we know that's a challenging segment of the market right now, maybe think about the things you can do in your business to attract more of the affluent borrowers in your market. Work some of the higher end stuff. Get familiar with the products that are important to those people. I would be focused on working with investors, because there are people that are taking their liquid assets or assets they have invested in other places and investing in real estate. And then I would also learn about some additional products. We've talked about non-QM. It's a massive growing segment of the mortgage market. So if you're not doing any non-QM business, that does tend to kind of skew towards the higher end market. People that are entrepreneurs, a lot of times doing bank statement loans, asset depletion loans, not as subjected to the pressures that higher interest rate environment would bring on. And then I would also be looking at reverse mortgages. Even if you don't do them yourself, many companies have a referral process to their reverse department, and you can make good money focusing on reverse mortgages, or learn how to do those on your own, because there's such an aging population that wants to stay in their homes, and a reverse mortgage has good amount of revenue. You can make good money on them. They are a longer process. I would say you have to speak to more people in order to get the conversion. It's not for everybody, but there are a lot of people that could really benefit from reverse mortgages. Maybe that's a niche that you want to look into. So just think about what the market's doing, and make sure as a sales professional, both on the real estate and mortgage side, you're finding the place where the buyers are, because there's transactions happening. You just need to find where they're going. And then lastly, I want to talk just a little bit about the market and give a quick market update. And look, guys, I got to be honest with you. I can't think of a time where it's more challenging. I mean, maybe during COVID, it was tough to predict what was going to happen with rates, especially in the very beginning. But right now is tough. There is a lot going on around the world that is impacting our interest rates. I will say that the outlook is fuzzy at best, right? At the beginning of the year, I think everybody had a very strong prediction that rates would be, in that under 6% range most of the year, right? We started off the year a little bit over 6%. We dipped down to the high fives, maybe even as low as 5 3/4 there at the end of February. And we were well on our way to meet most people's expectations. And the one thing I remember saying this on the podcast, it was like, well, unless there's some sort of a black swan event, that could impact this. And sure enough, no one saw this war coming. And as a result, as of recording this today, which is Tuesday, a couple days before it airs here on Friday, oil is back up to $100 a barrel. And the outlook is just a little bit sketchy. So I would just say in general that locking your loans right now is probably a good idea. We did see a pretty substantial sell-off when the war started, and then we saw about a 50% recovery. Not surprising when you think about the Fibonacci levels and what typically happens. We had a pretty steep downward move with interest rates, and then they hit the bottom. They bounced back up to about a 50% retracement. Not surprising, but we've started losing ground since then. And so we'll have to see where things shake out. Not a lot of talks about a resolution to the war as of the time that I'm recording this. And so I don't think we have a lot of room for, rates to spike back down, drastically, but I just don't see anything that's really bringing us the recovery yet. So we'll keep an eye on that. But here's another interesting thing that just happened. And that is that the UAE, the United Arab Emirates, announced that they will be pulling out of OPEC as of May 1st. So just in a couple days. And it'll be interesting to see what this does to the price of oil. Now, you guys know I'm so focused on the price of oil because it trends so closely with mortgage rates. But it is widely believed that with the UAE pulling out of OPEC, oil could actually get a little bit cheaper, especially in the short term. And here's why, is because OPEC is really known as controlling the supply of oil, right? They tell these countries that are members how much oil they can produce. They will decide how much oil is released into the market. And it kind of provides this nice cushion that helps protect from volatility in the oil markets, which can be a good thing. But we know the UAE wants to produce more oil. And that's part of the reason that it's speculated they're pulling out. Now, I don't know all the reasons behind it, but let's just say that they want to produce more oil. And if they do, it could have an impact in the short term on the supply of oil that's available in the market. And if that happens, you know what happens when supply goes up, price goes down. And then you could see kind of other countries and even OPEC wanting to compete with those sales of oil. And so you could see a little bit of a price war. Now, that sounds great to me, right? We see oil prices get better. But here's the trade-off. The trade-off is you flood the market with oil and these prices get used to this. And it's widely expected that this could bring significantly more volatility over time. And we kind of, with them being I think the largest oil producer in OPEC, it could mean that cushion that where OPEC kind of protects the market from too much volatility, that could be basically evaporated. And what that might bring is, when there is anything that disrupts oil, we see a much more parabolic spike in the price of oil. And we just see a lot more volatility, which you guys all know that's probably the worst, right? Is not knowing what's going on and seeing big swings in any markets, but especially oil because so much is dependent on it. But look, in the short, it's happening. So this is happening. It'll be interesting to keep an eye on that. I do think that in the short term, everything I'm reading says this could actually bring down the price of oil. And I think at this point, for those of us in mortgage and real estate, it's like, hey, we'll take it, but we'll have to see long-term what the trade-off of that is. So next week, I'm going to talk a little bit about our new Fed chairman. So as I speak here today, it's Tuesday. Jerome Powell is in the process of having his last Federal Reserve meeting as chairman. I don't expect any change to come out of that meeting, but I do think we're going to have some change moving forward, and I'm going to talk about that in next week's episode. So if you're not already subscribed to Market Shares, please subscribe, and I will see you next week. Take care.